Module 1.5, Forex Trading Pricing, Spreads and Position Size. The learning outcomes from this unit are to understand the price quote and the importance of the pip, to define what is meant by a Forex spread and its impact on your trading, and finally describe what is meant by a lot and how that influences trading position sizing. In essence, this unit covers some of the key terms that are probably new to you being a Forex trader. So it may be a module that you may have to repeat a couple of times just to grasp all of the concepts that we talk about. So let's start with the pip. We've covered previously that we're interested in the value of the base currency. Forex trading values, and hence profits ultimately, are all about the pip, which is an acronym for percentage in point. A pip is the last quoted decimal place of the currency and is the measure of a profit or a loss. With most currency pairs, it is the fourth decimal point that is the pip. Although in pairs with the Japanese yen or JPY, it is the second decimal place at which pips are counted. It influences the degree of profit loss in any trade, along with the dollar value per pip for that specific pair, and of course the size of trade you enter. For example, if the Euro USD is trading at 1.1712 and then moves it to 1.1739, with this being a fourth decimal point pairing, there are 27 pips difference between the two. It is also worth mentioning at this stage the fractional pip. Although we have previously referenced the fourth in the case of Japanese yen pairs, the second decimal point is the point at which a pip is measured. You'll notice on your MT platform, and we'll show you in a moment, that there is an additional fifth decimal point or third in the case of JPY pairs. This extra decimal point is present on both the bid and the ask quote on the list of currency pairs in the Market Watch table, the pop-up order books, and the quote in the top left-hand corner of your charts. We've given you an example here with the Euro Aussie dollar, and you can see there that there are 5 decimal points. It's the fifth decimal point, which is the fractional pip. And quite simply, the fractional pip is part of a full pip. So 0.00005 is 1/2 of 1 pip, or in the above example, the 0.00001 represents 1/10 of a pip in value. Having talked about pips, let's look at the spread. And this is the price difference between where a trader may buy or sell a currency pair. If you're a seller, you're selling where the buyers are prepared to buy. If you're a buyer, you're buying from a seller, and hence you're buying from where sellers are prepared to sell. So you'll notice here with the Euro US dollar spread that we've put up, we've got a bid and an ask, the bid being where the buyers are and the ask being where the sellers are. And you'll notice that there is a difference between these two, and in this case, it's 1.2 pips. So a little more about the spread. So although you don't pay brokerage as you would with share trading, for example, you should view the spread as the cost of entering the trade, i.e. you're in a small loss situation as soon as you enter the trade. For example, if the spread is 1 pip, you are 1 pip down if you were to close the trade immediately. Of course, values and the spread are consistently and constantly changing. And the spread is likely to be tighter the more people that are interested in trading the currency. So the majors, which we've discussed before, generally have tighter spreads than the minors. And so for that reason, many new traders just focus on trading the majors. And during certain market hours, the spread is likely to be tighter. Particular examples of this when both American and European markets are open. There's more traders in play, and hence there's more people buying and more people selling, so the spread is tighter. Now, a point of note here, there's lots of people talk about the spread, and though it is an issue to consider, as it does make some difference to your overall profit loss, it is not the major factor on changing your capital position. There are other things that are far more influential in terms of managing risk that we're going to talk about as we go through the forthcoming units. Just to give you a couple of diagrams to illustrate what we're saying, on the left-hand side you'll see the Market Watch box with a sample of some of the currency pairs that we've been talking about. And again, you'll notice that 5th decimal point, the fractional pip, on most pairings, with the exception of those that have the JPY involved, in which case there are 3, the second decimal point being the pip and the third decimal point being the fractional pip. Looking at the right-hand side on the spread on the MT4 order box, again you'll see exactly the same thing. The fractional pip is a slightly smaller font size than the larger 4th decimal point pip. Now let's look at the lot, which is about the size of your trade. And managing the size of your trade is an absolutely crucial part of risk management, and one that you really must get to grips with. Historically, Forex has been trading in specific amounts termed lots. One standard lot is 100,000 units of the base currency. We can also trade mini lots and micro lots, which are smaller sizes of trade, as illustrated in the table. So a mini lot would be 10,000 units of the base currency, whereas a micro lot would be 1,000 units of the base currency. The bigger the number of units you enter, the more dollar change you'll see for a 1 pip movement. So if each pip movement equals $10 per standard lot, then there'll be a $1 change for a mini lot and a 10-cent change for a micro lot. Here's 3 sample trades we opened almost at exactly the same time, a few seconds apart. The top one is 1 mini lot, as you'll see, in the Aussie dollar US. And you'll also see that the profit on this for the movement is $1.99. The second row is a standard lot, again at the Aussie dollar US dollar, opened within a few seconds. And for exactly the same pip movement, we've got a profit of $29.18. The bottom one is a micro lot, again in exactly the same currency, opened within seconds of the previous, and this micro lot has a profit of 21 cents. So you'll see the difference there, that the impact of position size has, even with the same pip movement. Conversely, of course, if we're down on all of these 3 trades, then the one standard lot position would be in a far worse loss than the mini or the micro lot positions. So your actions from this unit. Review the unit, as I said right at the start, to ensure you're very familiar with the key Forex terms covered in this unit. Open a trade on your demo platform to see the immediate impact of the spread on your profit loss. Remember, you're buying at where the sellers want to sell, and if you were to close that position immediately, you'd be in an automatic loss. And also on your demo platform, do exactly what I've just shown you there. Enter 3 trades of the same currency pair with different position sizing, as close as you can together, to see the impact of price movement on each. Make it happen, and we'll see you in the next unit.